Over the past decade, and particularly over the past few years, the housing market has seen historical growth that has been fueled by many different factors. We've had historic economic growth in the stock market, we've had historically low interest rates, and those two factors alone have caused housing prices to soar, it's caused bidding wars and all-cash offers for homes, and it's also led to private equity funds and corporate buyers who are flush with cash to flood the housing market, leaving many everyday Americans on the sidelines. But over the past couple of months, the housing market is starting to cool off, and many are predicting and argue that a housing crash like the one that we had in 2008 is inevitable. Now, while that is possible, I don't think a 2008 style housing crash is probable. I do, however, believe that the housing market is going to continue to cool off, and there will be better entry points for first-time homebuyers to purchase a home in the near future. In this video, I'm going to show you concrete data points and research on what makes today's housing market different from 2008. And if you guys are new to the channel, my name is Ravi Wadden, and I'm not selling anything. I'm just providing free financial tips and education. So if you could please help the channel out by hitting the like and subscribe button, it would be greatly appreciated. The first way that today's housing market differs from the 2008 housing market is credit scores. A recent Bank of America study found that 75% of homebuyers today have super prime credit scores of 720 or above. Now, during the years preceding the 2008 housing collapse, just 25% of buyers had a credit score of 720 or above. The reason that this statistic is important is that a high credit score typically means that a buyer has a lower debt to income ratio, which in turn means they are less likely to not make payments on their home and inevitably end up in foreclosure. And this was not the case in 2008. The second way that today's housing market differs from 2008 is lending rules. Back in 2008, a dog could get a mortgage. But seriously, the housing bubble that triggered the 2008 crisis was created from a combination of cheap debt, predatory lending practices, and financial engineering that led many borrowers being placed into unaffordable mortgages. And when the situation reached a boiling point, it provoked a foreclosure crisis among homeowners and a credit crisis among the investors who own bonds backed by defaulted mortgages, and that ushered in a global recession. During that economic downturn, household wealth declined for millions of Americans. From late 2007 through mid-2009, the Bureau of Labor Statistics says nearly 9 million Americans lost their jobs, and at the same time, the median U.S. household income dropped from $54,489 in 2007 to $52,195 in 2009. Although the economy and the stock market is again starting to cool off, I don't think we are going to see a crash of 2008 levels. Today's lending rules are much more stringent, and the quality of buyer on paper is much higher. But that brings me to the third way that today's housing market differs from 2008, and that is adjustable rate mortgages, also known as ARMs. Adjustable rate mortgages are home loans with an interest rate that adjusts over time depending on the fluctuation of market rates. They're less predictable than fixed mortgages, and they tend to change periodically and are considered risky as borrowers run the chance of paying much higher mortgage payments than they may have originally budgeted. In the years leading up to the 2008 housing crash, almost 40% of mortgages were adjustable rate mortgages, and subprime lenders loved offering adjustable rate mortgages because they enticed borrowers with low interest-only payments. But as the name suggests, adjustable rate mortgages are adjustable, and as mortgage rates began to soar, it created an affordability crisis because borrowers' monthly mortgage payments rose to a point where they couldn't afford the payment, and that pushed millions of Americans into foreclosure. The interesting thing is that adjustable rate mortgages are again gaining popularity in 2022 as rates are again rising at a rapid rate. But the difference is that lenders have strengthened the mortgage origination process, which basically means that today's adjustable rate mortgage borrower is in a much more secure financial position than borrowers back in 2008. The fourth reason that today's housing market differs from 2008 is equity. In the first quarter of 2022, about 44.9% of mortgaged residential properties had at least 50% equity in their property. That means that if the housing market were to correct by 15 to 20%, people aren't going to walk away from their mortgages and people aren't going to walk away from their homes. In 2008, when the real estate crash happened, many owners simply walked away from their property because of negative equity. In short, negative equity means that you owe more on your home than it's worth. And a lot of this was due to cash out refinancing that many homeowners took part in the years leading up to 2008. You see, during 2006 and 2007, borrowers tapped their home's equity like it was an ATM, and when home prices began to plunge, they were left owing more on their homes than they were actually worth. But today, most homeowners have more equity in their homes than they did in 2008, and they are refinancing their homes much more responsibly, not just pulling out cash to fund their lifestyle. The fifth reason that this housing market differs from 2008 is supply. There is no need to overcomplicate the housing market. Like almost every other market, price fluctuations are simply due to supply and demand, and in the years leading up to the 2008 housing crash, we had a lot of supply of homes. And as you can see from this chart provided by the St. Louis Fed, not only were home prices increasing, so was the supply of new homes, and that's sort of the inverse of what's supposed to happen in a healthy market. Normally, as supply increases, you would see prices start to decrease. But leading up to the housing crash of 2008, supply was increasing at a rapid rate, and so were home prices. And since the peak of housing supply in 2009, we've seen a much healthier housing market, especially more recently when the supply of new homes hit an all-time low following the global pandemic. And again, this is essentially Econ 101. As supply decreases, demand usually increases, and that's what we've seen driving this market, especially when you couple that with historically low interest rates. But as you can see, supply is starting to pick back up as pandemic-generated supply chain disruptions and material shortages are beginning to become resolved, and I'm really curious to see how this impacts housing prices along with higher interest rates. But I'm really curious to see what my subscribers and what my viewers think. Do you think that this housing market has any parallels to the housing market of 2008? And if so, what is your prediction for this housing market that we are in right now? But with that, ladies and gentlemen, I'm going to call it a video. My name is Ravi Wadden, and this is The Beat of Business. Please remember to like and subscribe. I will see you all next time.